This is episode 7 of my beginner trading education series. In this video, I'll be going over how to manage risk. So this is kind of the pinnacle of what differentiates amateur traders and professional traders, professional, super performance traders, if you will, is how you can manage risk. Any single person can put on a winning trade, just like any single person can win a blackjack hand or a spin at the slot machine. But the real question is, um, well, for one, how can you sustainably win? But two, how can you manage your risk in the worst possible situation, right? Can you perform the best in the worst possible circumstances? That's what differentiates the amateurs and the super performers. So today, the concepts I'll be going over will be what risk should you accept personally, and what makes sense for your personality, style, and math. Then I'll be going over stop loss and how it's step one of this risk management. And also, what percentage range of stop loss should you use, right? What makes sense? Next, position sizing. I'll be going over how you can reduce your risk with lower sizing. And I'll be going over how when your strategy is unfavorable, you need to lower your size. Then we'll be going into selling into strength and how that reduces negative portfolio volatility, how it helps secure winners, and how it helps increase capital efficiency. Then in capital risk, I'll be going over how you should always know your prevalent capital risk, how capital risk is also personality and strategy dependent, and how you need to optimize the math for your strategy around capital risk. Then for exposure, I'll be going over how you should look to increase exposure without increasing risk, how you should look to decrease exposure or decrease risk, with the same exposure. Then I'll be going over how you should lower exposure when your trading system is not working. Similar to position sizing, right? When strategy is unfavorable, lower size. So getting right into it, what risk can you accept? What makes sense? The goal is to manage risk for your overall portfolio. So one, you need to know what is comfortable for your personality. If you're a risk averse person, a 20 to 30% drawdown will feel like absolute hell. It'll feel agonizing. Now, if you're a person with a heavy risk appetite, it may not arise much emotion, which to me would be crazy. I would be losing my mind. But there are people out there that can go in a 20, 30% drawdown and then go on to make crazy returns for the rest of the year because they didn't let it arise emotion and they had a logic towards it, right? So number two, what is logical for your style? You need to define this and understand this, right? Because this is personal. Does a 30% stop loss make sense or a 10% capital drawdown? In my opinion, whoever you're learning your strategy from, they are your mentor. Figure out what they do, and obviously you can change it once you gather data. But as a beginner, you should follow your mentor for your specific strategy, whether that's a base breakout strategy or a day trading strategy, et cetera, et cetera. Understand what is applicable for your strategy and style. And then mathematically, what is forgiving for your style? So lower win rate percentage strategies go on longer losing streaks. Straight up, mathematically, this will happen over the long term, right? Um, anything, sorry, higher chance to bust if too high of risk, right? So if you go on a 10 losing streak, but you have a very small percentage risk, 0.1%, those 10 losers is only a 1% drawdown. But if you have a 10% risk, those 10 losers, now it would probably be about a 90% drawdown or whatever, right? But you get my point. You don't want to risk, if you have a 20% win rate, you don't want to risk 5% on a trade. And if you have an 80% win rate, you don't want to risk 0.2% on a trade. So there's mathematical benefits, to your strategy, right? Whether it's having higher risk or you need to have lower risk. So next is stop loss. This is literally crucial. Step one, predefine your risk on every single trade. Simple. Forever. Always. Now, number two, what percentage stop loss does your strategy benefit from? For me, as a base breakout O'Neill, Can Slim, Mark Minervini style trader, anything past an 8% stop loss is absolutely useless 99.99% of the time. Now, for other strategies out there, a 10 to 20% stop loss is necessary. So you need to understand your strategy and how this plays into risk and reward. Now let's get into position sizing. Point number one, how you can reduce risk with lower sizing. So you can drastically reduce your risk while still hunting for winners by reducing your position sizing. This allows for you to have the opportunity to secure winners to snowball off of without completely destroying your P&L with every single attempt you make to try and get into a trade. So this is step two to determine your risk, right? If you have an 8% stop loss at 100% sizing, that's 8% risk. But if you have the same stop loss at 10% sizing, you only have 0.8% risk. Now, point number two, when strategy is unfavorable, lower size. Doing this can keep you alive can is the wrong word, will keep you alive multiple times longer than if not. If you trade 25% size with 8% stop loss, but you're on a losing streak, changing to a 5% size will allow you to lose 5 times in a row with the same amount of capital risk percentage. I'll reference Occam's razor. Do not do more than is necessary to achieve your goal. So when your strategy is unfavorable, your goal is to secure winners of any size, not the biggest winners in the world, to break your losing streak, right? You want to break your losing streak. You want to gain traction and get the snowball rolling. Doing this lets you survive until then, right? Lowering your size when your strategy is unfavorable allows for you to have, more and more shots, right? More shots in the magazine. I made a sniper analogy in one of my videos. You could think of swapping from your sniper to a handgun or assault rifle. A lot more shots in an assault rifle than a sniper. So sometimes it's beneficial to lower your sizing when your strategy is not as favorable. So let's get into the point of selling into strength. Point number one for selling into strength is that this reduces negative portfolio volatility. So to protect your portfolio against negative volatility from snapbacks, increase capital efficiency, and secure stronger winners, you will want to consistently make this action. This ties into a concept called dynamic risk to reward. To put simply, if you have to hold through a 30% pullback for a 5% rally, that's a 1.5 dynamic risk, which doesn't make much sense and would induce absurd portfolio volatility and drawdown while costing time, likely taking a long time to recover, right? So that's opportunity cost on your exposure. So point number two of selling into strength is to secure winners. The classic rule of a strong winning trade is to not let it turn into a loser, right? That's why you take partial profits. That's why you play stop loss, break even, et cetera, et cetera. So the more selling into strength guarantees this can't happen. The more open profits you have secured, the safer your equity is, right? The more of your equity you've secured. Now, you don't always have to sell into strength with every single action, but this is a crucial skill to understand how to mitigate equity drawdown, right? This skill or this action has its pros and cons, and its cons are for mitigating equity drawdown. Point number three, capital efficiency. So if within 10 days of holding, your stock has hit your target or your average gain, you will have to pay a quote unquote capital efficiency cost to hold the stock through its next consolidation. For example, if up 20%, but you desire 40%, you may have to hold a 15% pullback, let's just say, and an extra 5 to 10 weeks, just for example. If the market is efficient and your strategy has a plethora of setups, this will only weigh down your performance by decreasing your turnover rate, right? Like I was saying in one of the previous points, opportunity cost, right? Opportunity cost in reference to your exposure. If you had 5% capital in that stock, you could have had it elsewhere and you could have secured 2 winners by the time that you only secured 1 winner. So going into capital risk, this comes into play with multiple trades at once. You need to understand what capital risk is comfortable for you, logical for your strategy, and mathematically forgiving. Personally, my goal is to never draw down further than 10% from my equity peak to my bottom of my drawdown. This improves compounding, but mathematically, this drawdown is also very forgiving. I'll go over some examples at the bottom. So point number one, always know current capital risk percentage. This is essential to maintaining controllable risk, because how would you maintain controllable risk if you didn't know what it was? But also for determining whether or not you are ready to increase exposure. If you only increase exposure together with risk, you're potentially building a house of cards, right? Almost like a Ponzi scheme on your portfolio. It's a bad example, but I hope the analogy gets across. It can swiftly crumble and bring your entire equity percentage along with it. Point number two, personality and strategy dependent. Some feel no stress with 10 to 20% of their capital at risk concurrently, and some feel stressed with anything more than 2% of their capital at risk. I'd be the latter. You cannot let emotions get the better of your decision making. My point with this is you need to understand what risk is beneficial to your strategy, right? Higher win rate percentage can bear higher risk easier because of smaller losing streaks. If you have a 20% win rate, you can go on a 30 losing streak. And it not just can, this is probable to happen across the long term, right? Across 1,000 trades, it is probable that you will go on, I think probably, like a 27-30 losing streak, the math would point towards. So you have to know how you can survive those losing streaks, right? If you're losing 2% of your capital 30 times in a row, you're going to be down 60%. You're going to be getting smoked. But if you're losing 0.1% of your capital 30 times in a row, it's only 3% drawdown. That's completely manageable, right? You have a few strong winning trades, you snowball your sizing, and instantly you're way past that. 3% drawdown is very manageable. So point number three, optimize to the math for your strategy. There are strategies that endure large losing streaks from having a low win rate percentage. But due to the high risk to reward nature of the strategy, it is mathematically beneficial for them to maintain larger sizing, going through a larger drawdown, but still having a strong edge because of the risk to reward. So you need to understand the math for your strategy. Now, here are some examples to understand. Minus 10% requires plus 11% to get to break even. Minus 25% requires plus 33%. Minus 33% requires plus 50%. Minus 50% requires plus 100%. Minus 90% requires plus 1,000%, right? So the nature of drawdown is the deeper you go into drawdown, the exponentially more you need to return to get out of the drawdown, right? To get back to break even. So now I'm going into the final point of exposure. You want to look to increase exposure without increasing risk. This can be done through position financing and progressive exposure. Position financing, I will go over at the bottom section of this. So point number two, look to maintain exposure and decrease risk. So this is done through making positions risk-free or financing other positions with closed profits. So stop loss break even would maintain exposure and decrease risk. Stop loss in profit, etc., etc. And point number three, you need to lower exposure when your strategy is unfavorable. So not just trading size, but also your overall capital exposure. So an important thing to consider when managing risk is exposure. The ultimate goal to snowball your capital is increasing exposure without increasing capital risk. This is a stepping stone effect where you are stepping off the winning profits from the previous trade or batch of trades to step onto a larger sizing with your worst case scenario remaining where you started. Say you made plus $1,000 on a trade you risked $500 on, so a 2R. You have now made enough to finance, quote unquote, the risk of two new positions, right? Two positions with $500 of risk you can finance because you've made $1,000 in profit. So from one single position, you have effectively doubled your exposure without increasing your prevalent capital risk beyond what it was prior, right? So this is a concept known as progressive exposure and is a little bit more of an intermediate concept, but is very valuable to high performance in your portfolio. This can be performed on a per trade basis as well as a wider capital basis. So that was episode 7 of my beginner trading education series. In this video, I went over some different risk management concepts and how you should approach each one. Thanks for watching. If you found value, please like and subscribe. Hope you have a good rest of your day.